Thank you, everyone. Welcome back to one more of the Faculty Insight series. Today we have with us Professor Venky Venkateswaran from the Economics Department at the Stern. Though you did not see Venky earlier in April, he was a co-author also of the presentation by Thomas Philippon on optimal mitigation policies during a pandemic. So Venky has clearly been one of the true real-time researchers during the last few months. He's going to present today his work with Julian Kozlowski and Laura Veldkamp on an important issue, which is, I'm sure, at the top of the minds of everyone, which is whether when the dust settles on the pandemic, will it be back to life as normal? Or will there be some long-lasting effects of the pandemic? Over to you, Venky, and we'll do Q&A once you are finished with the presentation. Thank you.
Thank you so much, Viral, and thank you all, and thanks for including us in this series. It's a pleasure to present this in this forum, and thank you all for attending. I look forward to hearing your thoughts and comments. As you can imagine, and as Viral mentioned, this is real-time research, so I think it's still very much being cooked as we speak. All right, so I think as Viral mentioned, I think the goal we're trying, or the question we're trying to grapple with here is what are the longer-term consequences of the COVID-19 pandemic and the associated economic crisis that it has sparked. So the hypothesis we're going to develop, or at least try to kind of quantify and measure, is that an event of this magnitude reshapes our thinking about risk. When I say our thinking, I just don't mean us as researchers. I mean businesses, consumers, what have you. So everybody's assessment about risks going forward has changed just a little bit, but it has changed. And that is going to induce a change in behavior, which would in turn have implications for economic activity going forward. And so that's kind of our hypothesis. And what we're trying to do is to quantify that. How big is this? Is this small relative to what we are currently going through, or is this roughly of the same order of magnitude? And the way and our approach in this paper is we're going to kind of start with a very simple model, a pretty standard model, and maybe with a couple of new elements here and there, and I'll point out where they are, what those are as we go along. And then kind of simulate a COVID-style event in that particular episode and in that particular model, and then try and measure what the longer-term costs are. And just to headline the result, when we do that, we find that these long-term costs, the negative consequences of this belief change are many times larger than the lost GDP in 2020 or 2021. Right, so that's kind of our main result, and I'll try and show you where that comes from. All right, so here's the idea in a nutshell. We're going to posit that, make a very realistic premise that nobody knows the true distribution of aggregate shocks, in particular shocks to the return to capital. Everybody re-estimates these distributions as new data arrives. We're going to kind of put some structure on it, but we're going to kind of keep it as flexible as possible. We don't want to assume the result. We don't want to kind of bake in something that makes the magnitudes much bigger than they are. So we're going to let the data speak, so to speak. And that's going to be the core of the paper, the core of the belief formation process. And I'll show you more about that in a few slides. And then we're going to kind of simulate COVID-19 by throwing in like an extreme adverse shock into that model. And as I'll show you, that's going to induce these large, fairly long-lived changes in beliefs, and in particular, assessments about these disaster risks, assessment about something really bad happening in the future. And then we're going to kind of build that into a macroeconomic model and then show how what that means for the trajectory of the US economy going forward. And the macroeconomic framework itself is based on something we'd used to explain or to think about the post-financial crisis experience of the US economy. If I have time at the end or in Q&A, I'll show you what the model says about that. And the fact that that framework turned out to be somewhat successful in understanding this episode is what kind of led us to use this as our kind of benchmark for thinking about the COVID-19 situation as well. Right, so that's kind of our that's the paper in a nutshell. So let me start. Given that we don't have a lot of time, let me kind of walk you through the main ingredients of the model. There's going to be a fair amount of math here on the slides, but I'm going to try and, given that we don't have a lot of time, I'm not going to walk you through all the equations, but I'm going to hopefully give you the highlights of what's really in there. So the model has kind of two blocks. One block is the epidemiological stuff, and there are hundreds of papers written, about how epidemiological considerations shape policy, shape behavior of agents, and so on and so forth. We're going to take a slightly different tack here, given our goals. So the basic model is something that you may have seen already. It's what's called the susceptible, exposed, infected, recovered framework, or the SEIR framework. And the basic idea here is that the number of new infections of the disease are a function of the contact rate between members of the population, right? So that's kind of that's the basic idea of the so-called R naught that you often hear epidemiologists talk in terms of. What we're going to and so what we are going to do is basically map a realized history of infections, as denoted by this delta IT term, to behavior, which in turn shapes this contact rate. So that's the idea. We're going to have this economy. It's going to see a series of infections, a rise in number of cases, and so on and so forth. Observing that number of cases, some combination of government-mandated shutdowns and private mitigating behavior is going to reduce the contact rate. When it reduces the contact rate, it's going to idle productive capital. So buildings may not be used, machines may not be used, airplanes might be lying idle. So there's going to, associated with this mitigating behavior is an idling of capital. The novel part, so all of this is pretty standard. The novel part is to kind of posit that as capital idles, there's a greater chance that it becomes obsolete. That something changes in the structure of that activity, which makes the existing capital essentially obsolete for productive purposes. So we're going to kind of think about that as like a faster, so the longer you idle, the faster you depreciate. And that's going to be the novel kind of ingredient here. All the other stuff, we're going to kind of try and just build on what other people have done before. And this obsolescence of capital is going to be the shock that agents that economic agents face and learn about. So that's kind of the basic idea from the epidemiological model. In terms of the macro model, again, we're not doing anything fancy there. We're not really innovating. We're going to have this shock as denoted by this Greek letter phi. That's going to be this obsolescence shock. That's going to enter the production function, and that's going to reduce the amount of output that a given unit of a given set of inputs can produce. So in particular, it's going to affect the return to capital. It's going to show a realization of phi less than 1 means that you're going to get lower returns than normal. We are also going to have default. Default is going to play a couple of different roles, and I'll explain that in a few slides. So firms are going to be borrowing in debt markets. So a bad realization of phi is going to induce more firms to default. So that's something that the model will have implications for. But it's also going to have an additional ingredient, which I think captures something quite realistic. Obsolescence itself is going to be determined or influenced by the extent of default. And so this is the idea that if a whole bunch of firms go bankrupt, supply chains are going to be disrupted. Even surviving firms have to make more kind of costly adjustments. You kind of have to reconfigure your business in some way, or your operations in some way. Or you could also capture things like very kind of straightforward externalities. If half the stores in a mall are bankrupt, then even the surviving stores in that mall or in that property are going to experience a lower value of operating because fewer customers are going to come. There's going to be lower footfall and so on and so forth. So all of those things are going to be folded into a mathematical representation by which default itself is going to feed back into the shock fee. So that's what this functional form here is. The exact functional form is not that important. What's important is that default and obsolescence have this kind of two-way feedback in them. So that's the kind of the macro side of the model. So all of this in some sense is pretty standard, maybe a couple of new elements, but for the most part, it's pretty standard. What's the belief part of the model? And that's kind of the core new, or perhaps the thing that's unique about our analysis. We're going to kind of have agents in the model behave like statisticians or econometricians. So they're going to acknowledge that they don't know the true distribution or the true uncertainty or the true distribution of shocks hitting the economy. So at every date, they're going to have a finite sample. They're going to have some realizations based on history. And then they're going to apply a particular statistical procedure. And that's what this Gaussian kernel density estimator is. And so so let me give you the intuition of this in 2 sentences. It's basically, it takes the histogram of a realized time series. So if you just plotted a standard frequency, standard histogram, and then try and draw a smooth probability distribution function around that, that's what the kernel density estimator does. And so this is a very standard procedure in non-parametric estimation. And we're just going to literally take it out of the textbook without any, with almost no modification. We're just going to literally feed in the data into this, into a canned procedure for estimating the distribution. Precisely because it's kind of flexible. We're not imposing that the distribution is normal or has fat tails. None of that stuff. There is no, this allows the shape of the distribution to be determined by the observed data that that we measure from historical time series. So that's going to be the key advantage of doing this. It allows us to kind of conduct this analysis without taking a stand on what exactly is the shape of the distribution that, much like agents in our model, we don't know either. All right, so that's the belief part of it. And so the main mechanism is basically going to act as follows. You're going to see an extreme realization of phi. When you see an extreme realization of phi, that's going to make the beliefs a little bit more pessimistic. I'll show you some pictures in a second. That's going to lower the return from investing going forward. Not only is it going to lower the return from investing, it's also going to increase the risk of bankruptcy. So, to the extent that you have to borrow to invest, that whole enterprise becomes less attractive than it was before. So both of those things are going to, this is going to be a double whammy on your incentives to invest. And so what that means is you're going to have lower capital and lower employment and lower GDP and so on and so forth. So that's kind of the way in which a shock is going to kind of transmit itself or propagate itself over time. And so where does persistence come from? The persistence comes from the idea that these beliefs, are on average going to remain pessimistic. Now, depending on, you can modify this so that the beliefs eventually leave the system. That's not quite so crucial, but however you do it, these beliefs are going to be with the age, are going to stay that way for a long time. So they become slightly more pessimistic and they stay slightly more pessimistic for, by most of our calculations for potentially decades. And so these effects are going to be with us for a while. And that's the source of the long-lived effects. So it's all coming in some sense from the fact that these beliefs are persistent, are not transitory, even after the shock itself, dissipates, even after a vaccine comes and makes the immediate health crisis, pass. All right. So with that kind of introduction, I want to spend a fair amount of time talking about the results. So let me kind of switch gears and talk about talk about the results of this analysis. Right? So here's kind of the game plan. Here's what we do. So first step we're going to do is to try and discipline what were beliefs of agents before the COVID crisis hit. And that's where we're going to build very heavily on our earlier work. We're going to use historical data from the US economy, kind of public macroeconomic data, use that to construct a time series of this shock fee, and apply the non-parametric estimation procedure from 2 slides ago. So that's going to give us a measure of what risk perceptions were in the pre-COVID era. And then we're going to construct, 2 scenarios for how COVID-19 is going to play out this year. This is partly because there's a lot of uncertainty about even the immediate effects of COVID-19. So the point we want to get across here is not that we have a model that's going to tell us what's going to happen in the next few months or the next few quarters. That's not the insight I want to communicate. What I want to kind of communicate is the idea that whatever happens in the next few months is going to have an amplified effect because it's going to affect beliefs going forward. And so that's the main idea I want to communicate. And so what we're going to do is to show you 2 scenarios. One scenario is going to be one with aggressive mitigation of the disease. So there's going to be a fairly drastic response by policy and by agents' behavior in response to infections. And that's going to have, that's going to work in terms of mitigating the disease or the health crisis with a high degree of success. But it's also going to have more drastic economic consequences. And I'll show you pictures on all of this in a second. The second scenario is one where the way we respond to the health crisis is going to be relatively lax. That's going to have bad outcomes or horrible outcomes as far as infections and fatalities and sickness and other things go. But it's going to mean less economic disruption. So these are the 2 kind of scenarios. And in both of these scenarios, we're going to calculate what beliefs are going to be like and what future time paths for the US economy are going to be. And I'm going to show you a series of graphs which are going to basically show the average expected future path for GDP, for investment, for employment, defaults, et cetera, et cetera. So that's going to be the main output of the model. And I'm also going to show you a simple calculation where we take these where we take these losses in terms of lost GDP and kind of turn them into a present value number. So we can kind of directly compare to what the immediate effects are. And I'll be much more specific about that in a second. Right, so that's going to be the game plan. I'm going to show you data on all of that. I'm going to walk you through all of these steps. All right, so let me show you first. Let me start with the disease scenarios. Again, the disease scenarios per se are not our focus. There's a lot of people looking at that, and as Viral mentioned, I've looked at that in other work. Here, the focus is really not on the disease side. The focus is really on the economic consequences of that. So the disease side is only going to give us a way to think about economic consequences. They're not directly our interest. And I really want to emphasize that. For example, we're not really thinking about what a policymaker should do if he's trying to trade off health and economic outcomes. That's really not what I'm after today. So here is what happens on the disease side under the aggressive scenario and under the lax mitigation scenario. So maybe this is the graph of the number of susceptible, infected, and recovered, including fatalities in the US. So this is in millions of residents. So here is what I want to maybe pay attention to the red line, which is the number of infected people in the US under this policy. So the policy on the right panel here is the policy, is this R0, is the policy expressed in terms of R0. So we're going to start off with an R0 of about 3.5. That's probably at the higher end of estimates. There's some work suggesting maybe it's a little bit lower, but it's a very contentious parameter at this point. So we're going to start off at the high level of 3.5. As infections come in, policy here aggressively is going to step in and reduce R0 pretty aggressively from 3.5 to about 1. which is often viewed as a critical threshold. But then once that kicks in, after a while, things are going to lighten up. And so the policy kind of takes its foot off the pedal. And then we're going to see the R0 go back up again. And then we're going to get what is sometimes referred to as a hammer and the dance type of pattern, where we're going to kind of take our foot off the pedal, but then slam it back on when things go south again. So you're going to get a little bit of this wave-like pattern here in the aggressive scenario. The lax scenario does not respond nearly as aggressively. So as a result, the infection rate peaks. There's going to be significantly more infected people under the lax scenario than there are in the aggressive scenario. But associated with that is a much more modest disruption to contacts and to economic activity. All right, so like I said, these are disease scenarios. This is not what we are really trying to innovate or we're really trying to push here. What matters is what it does to our estimates for the economic disruption. In particular, what it does to our estimates for this capital obsolescence. So this first scenario under our calculations, leads to about 10% obsolescence. So it reduces the economic value of capital in the United States by about 10%. The second scenario reduces it by about 5%. So that's what these two scenarios, loosely speaking, map this onto. So just to give you a benchmark, so if you look at commercial real estate prices in the U.S., relative to where they were in February, they are about 11% lower. So that's kind of gives you an idea about what this number looks like. So how do the beliefs work? So the blue line here, the blue solid line is the estimated distribution pre-COVID. That's what we call the prior. Then you're going to get a new observation, and then you're going to draw a new updated distribution, which is this red dashed line. As you can see, for the most part, that distribution looks exactly the same as it did before. All we've done is basically add a small bump all the way on the left where we got this new data. So that's how this kernel density estimation works. We're just going to add, a little bit of a bump wherever we get new data. Under scenario 2, that bump occurs a little bit to the right because the observation itself was was perhaps closer to 1 than here. So these are the two distributions, and we're going to contrast what happens to economic activity under these two distributions, right? And that's basically the second part of it. So here is what happens when you kind of feed this into the model. So these graphs show the change in aggregate GDP relative to the initial point, relative to where we were before the COVID crisis hit. So let me focus on the blue line, which is the model with learning, in other words, where beliefs are changing. So there's an immediate shock, and that just reflects it. I've just made a bunch of your capital obsolete. I've forced you to idle your capital. All of that put together basically means you're not going to have much GDP in 2020, right? And you're going to have lower GDP in 2020, and that's what this immediate impact represents. So that in scenario 1 is about 9%, right? So GDP in 2020 under scenario 1 is forecast to be 9% below normal, right? And that's in the ballpark of what most Wall Street forecasts and what the Fed forecasts and what several other professional economists are forecasting. The interesting thing is what happens after that the shock goes away. For a while, because I've just rendered a bunch of your capital obsolete and it takes time to replenish it, GDP is going to be low anyway. Right? So that's what I'm going to call the obsolescence effect. So I've just taken away some resources from you, and so you are going to have depressed activity for a while. The innovative part is the second one, which is what we are really interested in. Your beliefs have changed, and so because your beliefs have changed, you don't want to go back to how things were, or you don't want to go back to the normal level of capital from before the crisis. You're going to kind of in a permanent fashion invest less. And that's what the belief scarring mechanism that we are really interested in. So on the next slide, I'll show you how much of this comes from the first and the second. There's also the possibility that these pandemics occur again in the future. That's kind of mechanical, so I'm not really, I'm not going to focus on that. And that's part of this, but it's a relatively small part of this. So here is this calculation. Here is that decomposition between GDP and between capital obsolescence and belief scarring. So just to kind of go back here, our baseline prediction is that GDP is going to be 5% lower, kind of almost permanently out into the future. Right, and if you look at where that comes from, this orange area is the component that's coming from the belief scarring, and this gray shaded area is the component that's the direct effect of the obsolescence we've kind of fed in. So as you can imagine, the obsolescence is kind of important in the short run, but as your horizons extends out, you're going to see, less and less of this obsolescence effect because the economy kind of figured that out or sorted that out. But the belief scarring effect really kicks in as you go forward, and that's what you see. This orange area basically accounts for almost all of the long-term impact. And if you kind of calculate a net present value with a risk adjustment and all the fancy stuff you want to do, if you did that, you're going to end up with, a number where the net present value of this orange region in scenario 1 is going to be about 50% of 2019 GDP. Whereas the contemporaneous drop, the drop in 2020 GDP is about 9%, as I said earlier. Scenario 2, all these numbers are basically, are about 2/3 of these numbers. There's some nonlinearity, so the worse the crisis gets, the worse the belief scarring, so there's a little bit of that. But absent that, the scenario 2 is just a milder version of this. The important thing to note is that even in scenario 2, the belief scarring component is several times the 2020 GDP drop. And that's the sense in which, these longer term effects are much larger than anything we're going to. So in a world where you think people are going to learn from this experience and modify their behavior going forward, these longer term effects kind of overwhelm the immediate consequences of that. Right, so that's kind of my headline result here. I'm going to show you a couple more slides, and then I want to kind of conclude, and then we can get into Q&A. So what's really underlying this, as I said earlier, is this idea that when you're pessimistic, yes, I've rendered some of your capital obsolete. Normally, if I didn't have to worry about your beliefs changing, if I render some of your capital obsolete, you're going to jump in and replenish that capital. You're going to put in new buildings, new factories, new machines, what have you, right? That's what happens when technological changes make, capital obsolete. Here, there's an additional negative effect, which is that, you're a little bit more pessimistic going forward. So you're not that excited about replenishing that capital. And that is the effect that's going to, so it essentially acts through investment. It's going to keep investment low, and through investment low, it's going to keep capital low, and therefore lower GDP, employment, so on and so forth. Right? So that's basically the core of the mechanism. So I'm running a little bit low on time, so let me just show you 2 other pictures, and then I will, the rest we can get to on Q&A. Right, so this is what happens to defaults. So in the short run, in 2020, the model predicts that defaults are going to spike from a normal of about 2% to a high of about 6%. So this is pretty dramatic, but it's still quite a bit lower than what we saw in 2008, 2009, for example, during the financial crisis. But interestingly, the spike in defaults does not really last. And the reason it does not really last is because the pessimism that is introduced by the belief scarring mechanism also makes firms less willing to borrow, so debt also goes down. So firms are kind of delevering in a sense to respond to this to operate in this new world. And so the actual change in defaults going forward is not that high. So that's something kind of interesting to keep in mind. So here's my last slide, and then I'll hand over to Viral for Q&A. The model has a bunch of implications for asset markets. I do want to make one kind of overarching comment here. The place to, most of the implications for asset prices in this model are going to be relatively modest. So, credit spreads are going to change, like I said, by about half a basis point or a basis point. I mean, there's going to be a lot of default this year, but then going forward, defaults aren't going to change that much. It's not a lot of change in credit spreads. There isn't that much of a change in equity, or at least book to market type of ratios. The PD type of ratios don't change a whole lot either. Risk-free rates change. So that's one place you can see that a safe asset like US Treasuries becomes much more attractive. So you're going to see a big change in the interest rate on those claims. What is interesting is, or what is perhaps, but these are all changes which might be kind of rather imprecise signals of a change in perceived tail risk. Where you see a much more kind of clear effect is in options data. And so these are two kind of statistics we're going to talk about from options data. So if you look at out of the money put options on the S&P 500, the model predicts a fairly substantial increase in the implied probability of a negative event. And that's what these two numbers here are meant to capture. All right, so let me kind of end with that. I'm happy to talk about policy. So one of the things that the model implies is because there is this feedback between defaults and obsolescence, by mitigating default, you're also mitigating obsolescence and therefore the scarring effect. So by kind of intervening aggressively through financial policy, which reduces defaults, let's say if you go back to my picture where defaults went up by about 6%, if you could bring that down to something much more normal, the payoff from that in terms of longer term benefits dwarfs the immediate benefit of that. The immediate benefit is obviously there. You have more economic activity in 2020 and maybe in 2021, but these longer term benefits about how you manage the economic fallout of the crisis are substantially bigger than what you're going to get in the next year or so. So that's kind of the main message of the paper. So I want to leave you with that kind of punchline, that this is an unprecedented event along several dimensions, and so the after effects are going to be felt for a while. And at least in a quantitative sense, those after effects are much, much bigger than the question of whether we're going to be in a recession in 2020 or at the end of 2020 or 2021. And our kind of overarching message is that those numbers, those estimates of longer term effects should form part of any policy debate, whether on the health side or on the economic/financial side. So I think that no matter what you think, what scenario you think, how this is all going to play out, those longer term effects must be part of the conversation. And I think that's what we want to emphasize as the main message of the paper. All right, so let me kind of stop there and hand it over to Viral for Q&A.
Thanks. Thank you, Venky. That was really terrific. I think you presented it in a very transparent fashion in spite of all the technical details. Let me start off with a couple of questions. We were actually casually bantering around these questions before the forum started, which is, so one view of bankruptcies is that they are socially costly. Another view is, of course, sort of more Schumpeterian, which is that, there's some creative destruction involved in bankruptcies, and usually they enable a shift in the allocation of resources to the more productive use. Right. Perhaps the world is, as of now, somewhere in between, in the sense that many of us would agree that if the revised beliefs about risks of pandemics are right, then perhaps there should be some alteration in the way production is organized in the economy. Mm-hmm. Now, clearly, given the irreversibility of investments, this may require some painful adjustments along the way. Nevertheless, it's, as you said, defaults probably do have externalities, especially if they happen in a very large number in a very short period of time. Mm-hmm. And there's this talk about trying to ensure that the bankruptcies don't rise beyond a certain point, as you mentioned, to limit these externalities. So that's a long prelude to the question I'm going to ask. The question I wanted to ask you was, should one think in the model and in general about potential beneficiaries of an episode such as the pandemic, where even though the beliefs revise the way in the manner you have discussed, there is some production alterations that take place so that actually the loss in the output is not entirely due to the capital that becomes obsolete, but some new capital is going to be created in these productive frontiers of the economy for future.
Absolutely. Yeah. So I think that's a great observation. And in some sense, the way I've presented it, the way the model is written right now, it kind of abstracts from that in the following sense. It says, yes, we built a huge mall in 2018, and come 2020, we took a big hit to that mall. So the way we are kind of thinking about agents in the model is that they're thinking about the next unit of capital they're going to invest is also subject to a similar risk. Well, one possibility is that the next unit of capital is kind of qualitatively different from this and might be less vulnerable to the same risk. So even if everybody says, pandemics are going to keep coming up, they might say, but no, I'm kind of investing in a different form of capital that might be less, susceptible to the type of obsolescence that you've highlighted. And I think that's a first order question. So in some sense, it's a question of magnitudes about how much that substitution away from the traditional types of capital to the newer forms of capital can happen. And I think, if you kind of think about some of the most capital-intensive sectors of the economy, it's things like healthcare. It's actually incredibly it's also very labor-intensive, but it accounts for a big chunk of investment as well. So some of those sectors, up until now, we haven't seen, at least, let me put this, I want to be careful here. We haven't seen a dramatic kind of technological transformation that has happened yet. But to the extent that happens, that's going to mitigate the negative consequences I've highlighted. So I think, at the end of the day, we thought about that, but we didn't really have a quantitative way to discipline it. So we kind of stayed away from it altogether. The way you would think about it in the context of this model is that you can imagine there are two forms of capital. We could have always thought remotely, but we chose not to because the cost of doing that relative to the benefits led us to teach, in classrooms. Now that calculus would have shifted a little bit away, and we're going to use that alternative form of capital, which is a somewhat imperfect substitute for what we were doing earlier. But that's how we're going to kind of operate going forward. And I think that is something we're trying to figure out. My kind of maybe somewhat pessimistic view is that, for the economy as a whole, those substituting technologies are not going to be big enough to kind of make these effects go away. But I do agree that they are going to kind of attenuate the numbers that I showed you a few minutes ago.
Let me raise a question that's come from Tom Pugel, Venky, which is, does your model have implications on the effects on national saving on the equilibrium paths? His question is, where does the national saving that is not being put into real investment go if because of the scarring of beliefs, not enough real investment is taking place?
So that's a great point. So in the way the model is set up, so there are two things happen at the same time. I've just come in and whacked a bunch of your capital and made it obsolete. So you have less stuff anyway. So you're, as a fraction of that less stuff, you're still saving, you're saving a certain fraction of that and investing in it. But it's not like I started you out with the same pool of resources and you decided to invest less. So let me maybe kind of state that a little more clearly. I could have posited the following world where there was no obsolescence shock, but agents' beliefs went forward. Then they would have extra resources that they would have something to do with. Here, the fact that we had a big negative shock means that the extra pool, the amount of resources on the table to be split between consumption and saving itself is a lot lower. So there isn't a lot of extra resources. So if I looked at the time path of consumption in the model, which I did show you, that also drops and stays low. So, in this system, the main thing, maybe the point I want to emphasize is the opposite. If we lived in a world where beliefs did not change as a result of this, then, what the economy would have done in the next few years is cut back much more drastically on consumption and invested much more aggressively to replenish the capital. That's what the belief scarring mechanism kind of turns off. That's what the belief scarring mechanism undoes. So in some sense, the excess saving here is going to be, relative to that benchmark rather than rather than other way. I hope that, I know it's a little hard to do that without the equations, but hopefully Tom and the rest of the audience was clear.
Yeah, no, that's a great point, Venky. Just coming back a little bit again to the issue of belief scarring.
Mm-hmm.
So I think your last discussion on the policy implications was particularly intriguing, which
Mm-hmm.
is that that the use of a pool of social resources in order to mitigate the incidence of bankruptcies could actually bring the levels of investments back up to higher levels at a faster speed. So I have two questions related to that, which is the belief updating inefficient in some manner? What I mean by this is that what the reason why the limiting the number of bankruptcies improves outcomes, is it because you are improving the belief updating process, because somehow that's not getting to the truth at the right speed or at the right level, or is it that it's directly actually by reducing the pace of obsolescence, making it more attractive to invest in capital?
That's a great question, Viral. So let me clarify the efficiency part, and then maybe that'll help me answer your question. So the belief updating per se is, there's nothing irrational about that. There's nothing behavioral. We haven't added any other ingredient there. But the economy itself is inefficient for various reasons. One, which is of particular relevance to the question you raised, is that default itself is inefficient, because private agents are going to decide whether to default or not based on whether they have enough resources to do their debt. They don't internalize the fact that by defaulting, they are exerting this negative effect on everybody else. So, even though people's beliefs are right, it's this mapping between defaults and this thing that leads to an inefficiency of sorts. So what the policy is in a sense doing is trying to kind of correct, at least in this extreme event, correct that negative externality. And by correcting that component, so let me kind of maybe use a numerical example. So say the primitive shock is at 10% obsolescence. Default turns that 10% obsolescence into, say, a 15% obsolescence. So what policy is doing is saying, well, we can't do anything about the 10% obsolescence and people learning from the 10% obsolescence. We're going to bring the 15 back to 10. And then so people are going to go forward, rather than think we lived in a 15% obsolescence world, they're going to be thinking about the 10% world. So that's what that does. I mean, it raises a broader question about, in a world where default, so the crucial thing is this default amplification really only kicks in these extreme events. When things are normal, the default related inefficiency is kind of small. So this tells you that one way to manage these extreme events is through a concrete policy, which says, I'm going to address what is obviously an inefficiency because people are making private decisions to close down shop without internalizing the effect on the broader economy. So I think that's how I want to kind of frame the thing. If on top of this, if you thought that beliefs were inefficient, and there is lots of evidence for how there's recency biases, there's all kinds of biases you could throw in, those things would only strengthen the case to kind of intervene and try and nudge here that way. Here, all of that's happening only because defaults are, so in a world where the default obsolescence feedback was absent, we'd be hard pressed to recommend policy, any useful policy in this world. Again, you could posit that the policymaker knows better than the economy, better than the agents about the true nature of risks facing the economy, but short of that paternalistic view, there'd be no reason to intervene. Default, I think, gives us a concrete reason to intervene, even without the paternalism of knowing the truth about the world.
There seem to be two questions from Yakov Amihud, but I'm not seeing the questions, unfortunately. So let me jump to Larry White's question in the meantime.
Great.
So Larry's question is on the differential between your two scenarios, Venky. He's saying, are the differences potentially being overstated? He's saying, after all, let's take the example of the airline sector. The domestic airlines were whacked badly, even though they were never forced to shut down.
Correct.
And maybe with a little bit of a lag, consumers would have similarly learned to avoid the restaurants, movies, etc., even if they were not formally shut down. And so I think he's really asking the question of whether shutting down by itself is really the mechanism through which the learning is taking place.
Absolutely. So this is my fault. I should have been much clearer. What we called, what I call policy, I wasn't only thinking about, a mandated lockdown from governments or policymakers. We were trying to capture all mitigating behavior, whether it's the result of agents by themselves kind of scaling back activity or by the result of mandated lockdowns. And as Larry pointed out, there's a lot of evidence, both from around the world and even within the US, that even when an official lockdown is lifted, it's not like things just run back to normal. So that's that's one thing I want to emphasize. The second, so the way the way I like to think about those two policies, you can kind of think about them as in terms of the disease or the epidemiological kind of paths. My preferred way is to think about them as representing two, economic scenarios. One represents a fairly dramatic, crisis where 10% of the capital in the US suffers from this obsolescence shock, and the other where only 5% does. So I think, the exact constellation of ingredients that delivers those economic outcomes, I think there's a lot of uncertainty about that. Not in the least about, what behavior would be going forward. I mean, take the example of airlines as saying, are we going to return, let's say a vaccine comes back. Are we going to jump back to travel to the same degree as we did before? So there's a lot of uncertainties surrounding that. And I think the scenarios kind of lump all of that into one number, saying one is a 10% and the other is a 5%. And I think at this stage, we spent a lot of time trying to think of, how we might discipline them further. I think, this is one of the pitfalls of real-time stuff. We really don't have data yet to start, piecing that together. So most of the forecasts we have today, confound what's going to happen in 2020 with what's going to happen perhaps going forward. And I think we haven't found an effective way to disentangle the thing we are really interested in, which is the longer-term stuff from the immediate effects. But I think that's something that certainly deserves a closer look.
Okay, so I do have the questions from Yakov now. His first question is on the nature of default or bankruptcy. This is something that Larry White has also alluded to in the forum when he was talking about public policy, which is that default or bankruptcy is not a shutdown. In fact, the US bankruptcy code allows the assets to continue operation. And one view of bankruptcy is really that it's a financial restructuring for most part, rather than an operational restructuring of the assets, though there may be operational restructuring of assets as well. And so he's saying, how crucial then is the fact that you are implicitly assuming some significant real investment or operational costs. And the example is Yakov's giving is that even an all equity firm in a mall would shut down if the future were bleak.
Absolutely, yeah.
And so that's not really an inefficiency of any sort in that sense. Yeah.
No, that's fair. Okay, two comments. One, let me give you a quick answer on the magnitudes. So suppose we turned off this obsolescence default feedback. That knocks off, loosely speaking, a quarter of the results. So it's economically meaningful and it's non-trivial, but it's not the basics. So even if, as exactly as Yakov pointed out, we could have said, imagine you lived in a world where there is the possibility of default, but there is no real consequence of default. So one thing so in other words, default is a purely private affair. That maybe the debt holders lose at the expense of somebody else who makes money on this. We can do all of that stuff. Even in that world, almost 75% of the numbers, the effects I showed you are still going to be there. That's one. Second, I don't disagree that, Chapter 11 is different from Chapter 7 in terms of thinking about going operations. What we want to capture is that even when a firm is in Chapter 11, if it's going to be in Chapter 11 for a while, it creates uncertainties and vulnerabilities all along the supply chain. So if you thought, this was something that came up in 2009 when they were trying to adjudicate the GM situation. They were really worried that an extended, long-winded restructuring process would have ripple effects on an entire kind of, ecosystem of suppliers and other people. And so those are the type of effects we are trying to capture. It could also be something much more mechanical, that if United is under Chapter 11, I'm going to imagine that they're going to maintain their flights a little bit less, or maintain their air fleet a little bit less effectively than they did before. There might be fewer investments in upgrading, so there could be things like that as well. But I think the first kind of things I talked about, where a major part of the economy mired in Chapter 11 proceedings for an extended period of time, has negative consequences. It's not literally business as usual. It has negative consequences for a whole bunch of people. That's something we don't have so the default obsolescence feedback is something we don't have direct estimates for. We've tried to kind of do that, but nothing that we can use for the aggregate economy. We have some more micro estimates, but we don't have something much more. So we kind of calibrate it inside the model. But I think that's something we should probably refine with better micro estimates.
Thanks, Venky. Let me jump to one of your sort of very interesting insight from the model is that because the occurrence of these tail events leads to a revision in the expectations for future pandemic-style events being more likely, that belief updating leads to an aversion towards taking on debt.
Right.
Now, while we have seen a bit of that, on the one hand, there are many anecdotal examples of companies that have actually tried very hard to actually generate forms of cash.
Right.
So, there were these examples of PNC Bank getting rid of its stake in one of the large asset management company because, they were reliant on wholesale finance and they wanted to have more cash at hand. Mm-hmm. On the other hand, we've also seen dramatic issuances of debt over the last 2-3 months.
Right.
And while, clearly one may attribute a big chunk of that to the backstop that's been offered by the central bank and the government, I just wanted to see if you could link a little bit on the scarring of beliefs that's happening in the model with the dramatic reversal in the stock markets, credit spreads, and the sheer quantum of bond market issuances that we have seen over the last two months. So how do you make it all sort of gel together?
That's a great point. So in the model kind of leaves those things out, partly because we have like an annual frequency. This is not sufficiently high frequency enough. So the way I kind of try to think about that is, if we wrote down a more granular model where firms were making decisions day by day and trying to kind of mitigate this disaster at a higher frequency, trying to deal with the immediate consequences of the disaster, I bet we would see, my conjecture is that we would see an uptick in debt immediately as well. So I think, in the model, in some sense, it's a little bit artificial. Firms walk in with some debt, they see that their economic fortunes have gone south. They just have to decide whether to continue operating given the debt obligations they have or just shut up shop. So some fraction of them choose to just shut up shop and walk away. If on the other hand, a more realistic description is you walk in, yes, there's a shutdown or there's a disease. You don't know how long it's going to last. You don't at this stage even know whether you should fold up shop or not. You want to certainly stick around and see how all this plays out before you do that. And I think that behavior of like that initial stage, that richness, we've kind of completely left out. And I'm almost positive that will lead to at least a significant chunk of firms saying, okay, Obviously, I don't have any revenues. I have to kind of continue to operate. I have some expenses I need to meet. How do I do that? I'm going to borrow, draw down on lines of credit, use whatever I can to kind of survive this. And then maybe at the end of this, let's try and decide whether we want to continue operating or not. Like, for example, everybody's been talking about this wave of bankruptcies that's coming. The bankruptcy filings haven't really yet reflected that. And in part, it's because everybody's playing this option value game of saying, let me see how this thing plays out before I rush out the door and start filing, what is really a very costly default restructuring process. That's one comment. And the second, which is maybe, which I'm going to build on what you were saying, maybe go a little bit beyond. One thing we haven't done, which we might see going forward, is other forms of precautionary behavior by firms. That might involve things like lines of credit going forward. In other words, they might say, one way I'm going to prepare for this type of scenario is to have a contingency source of capital available. If I have the luxury of issuing equity and sitting on a pile of cash, great. If I don't, I may have to think about putting in place a backup plan like that. And I think that's something we're definitely likely to see. We may see a combination of all of these things where firms maybe are less levered, but have contingency financing in place, or at least have a greater demand for contingency financing in place, and perhaps hold greater cash as a buffer for various things. And I think so there's going to be a lot of richness in the way I think businesses are going to adapt to this new world, especially the vulnerable ones. And that's something, the model kind of leaves out, but I certainly acknowledge is going to be an important part of what we see.
It's great. Venky, we've just run out of time. I particularly, I want to end with this one observation, which I think is striking also in your last set of slides, which is that there was this phenomenon observed in the options markets that after the October 20th, 1987 crash, jump risks, which did not used to be priced in the sort of the implied volatilities in the options markets, actually started getting priced. And of course, a whole set of new wave of models for option pricing was written thereafter. And I think it very much sort of squares in with this fact that beliefs shift permanently post some of the realizations of these tail events. Thank you very much, Venky, for joining us. Thank you to everyone in the audience as well. Enjoy the summer and phase 2 of the gradual relaxations. And I hope you stay well and safe through the rest of the summer.
Well, thank you, Viral. Thanks, everyone, for participating, giving me the opportunity, and hope you are safe, and look forward to seeing you all in person soon.
Thank you. Thanks, Venky.